Welcome everyone to the video on a long-lived asset where we're going to talk about the disposal of the older long-lived assets. People, let's not make mistake. And at the outset, I want to make it very, very clear that long-lived assets by design are those long-term assets where the primary purpose is not to make money by selling them, but by using them. And in this video, we're going to talk about selling them. So I don't think it should, communicate to you in any manner that what we are going to do has been the primary purpose ever. No, the primary purpose has been the depreciation, wherein the fall in the value of the asset because of the usage. That's why that video was very long. That's why it had too many concepts. And that's why we said depreciation is really the hero of the show. Okay, so right now, the topic at hand is the sale of a long-lived asset, perhaps at the time of retirement, perhaps at the time of before retirement. So sometimes you plan to use a particular mobile phone as a student for 4 years or 3 years, but then for some reason you have to change it after a year. And that is really the moment where you got to dispose your older long-term asset. And like again, I'm repeating again at the cost of sounding boring, that sale of your old mobile phone is not the primary reason why you got it. Okay, it was to use it for a business purpose. Okay, good. Now, at the time of sale, generally you got to find out two things: the selling price and the cost price. And as you know, we were told in the school where the gain and loss was equal to the selling price minus the cost price. The understanding of what constitutes the selling price is critical, and understanding of what constitutes the cost is critical. If both these things are clear, A minus B is equal to C. So C, the profit or loss, is actually a derivative which derives its value from the difference between the two variables, selling price and the cost price. So you have to be very clear about it. Doesn't matter what the question gives you as details, try and get to this A and B, the selling price and the cost price. Okay, now let's come to the selling price first. I'm going to quickly want you to recall the 6 valuation bases that you've done while making your balance sheet. One of them was realization value, wherein we said that it's the value at which you will sell your asset. That is my selling price. And I'm also mindful of the fact that there was a selling cost. If you deduct from the realization value, gets the net realization value. That's my selling cost, people. Okay. And the second aspect is the cost, which is nothing but the value of the asset in your books today on the date of sale. That means, which was the second valuation base of amortized cost. So here is a very simple statement, people. Out of the 6 valuation bases, one of the valuation base is my selling price and the other valuation base is my cost. And on that day, while we were doing those valuation bases on the balance sheet, I told you that there are a lot of practical applications that will come. This is perhaps one of those, right? Let me bring a very simple equation to you. So you see here, you have the proceeds, which is the selling price minus the carrying value. Put it very simply, your realization, the amount that's going to come from the customer, minus the brokerage, etc., the net realization value will become your net proceeds. And the carrying value is not the value on the recent most or the immediately preceding balance sheet date, but on the date of sale. And this is the point where you have to understand that in case you're, let's say let me take a quick example. Imagine a January to December as the accounting year. So the previous balance sheet must be made on 31st of December. Imagine you're selling the asset on 1st of February. That means the cost of the asset that you have is recent most available is of 31st December, which is a month older. You have to, for the purpose of this gain or loss, calculate the depreciated value, which means you got to calculate the pro rata depreciation for the month of January, reduce your amortization value further, come to the revised amortized value on 1st of February, and then that's your cost price, ready hand. It's fairly simple. Okay, in some way or the other, sometimes we are going to confuse you by giving you different structures of these selling price and the cost price. Make no mistake, make no mistake. One of the other very famous way that we trap a student in terms of exams or an interview is to give you the historical cost and the accumulated depreciation. Well, the two, historical cost minus the accumulated depreciation is nothing but the amortized value on that day. So I bought my phone for 40,000 rupees, and till date I have charged 24,000 as the depreciation. That means the cost on this day is 40 minus 24, 16. That's the cost price. And I sell it for, let's say, 15,000. So 15 minus 16 minus 1,000 net loss is the result out of that. Okay. Sometimes there is a question that rather than selling it, you exchange it, or you abandon your asset, or you scrap your assets. All of that is going to change your selling price. It's not going to change your cost price. The cost price remains the amortized cost. If you abandon it, that means you're not expecting any return to come. That means your selling price is going to be zero. If you scrap it, that means the NRV is going to still be counted, but that will be much lower, much smaller in value. If you exchange it, then the selling price actually is the value of the asset, the new asset, or whatever is that exchange asset that acquired in exchange of your older one. So make no mistake, people, all the different forms of disposal will change your selling price, will not change your the cost price. Okay, I'll welcome you in the live class with lots of examples on that. It will also have an implication on cash flow statement, where whatever you're going to realize out of the sale is actually a cash flow from investing. Remember, operating, investing, financing activities, this sale is an investing item, people. Usage of long-term asset is operating, but selling and buying, both, is investing activity. So any loss or gain that you derive out of this transaction is not going to impact your EBIT, is going to impact your the second half of the income statement. So what is the impact of a sale of a long-term asset on EBIT or operating? Answer is zero. Okay, depreciation and impairment loss definitely impact your EBIT. So long-lived asset, therefore, that is very interesting. They are business, but some part of them is investing, the buying and selling. Okay, that's what we are going to talk about in our live class. I hope you've got a good sense of what we're going to do in terms of disposing, what we have as a long-term asset, although that's not my primary job, right? Looking forward to speak to you in the live classes very soon. Thanks very much.